Hey, good afternoon, everybody. This is Andrew Giovinazzi from OptionPit.com, 30-year trading professional, director of education, COO, OptionPit.com. So I get a lot of questions here. There's our website here, OptionPit.com. Been getting questions about, how is the VIX going up? Oops, I got to get all these things right. There we go. Like why is VIX and SPX going up? So you see SPX up a little bit today and VIX up 16 cents. When you would think everything you're here, it should be the opposite. So the first thing you have to remember is, what is the VIX actually measuring? So options between 23 and 37 days out. So once they listed the weeklies, the VIX calculation changed, but still it's all the options with a bid, in that cluster of options from that period of time. The easiest way to think about it is VIX is telling you kind of what the range the market expects the range to be for 30 days. So what is 30 days worth? Now, the thing with the VIX calculation, since it does catch every option with a bid in that kind of cohort of time, lots of things can move VIX up and down. So if you remember how volatility works in an index product, vol can expand at the money. Every strike can expand. The skew curves can move up and down. Basically, it sort of looks like this. So if you have a volatility curve, looks something like this, rough. Okay, so this is over here, like we're here, right? And then we're here like this. And then we've got so these are your strikes going, this is your implied vols here, and this is your at the money strike here. So this is your strikes going, let's say, to 7,000 SPX, and this is, 3,000 SPX. So the curve basically looks like this, although there are cases here where those short-term calls kind of slope upward. So when you're thinking about how a volatility curve can move, like the whole curve can just shift up. Basically, all the vols move up sort of equidistantly, and that's when you have the big moves in VIX higher, because all the vols are going up. You can also have a shift lower. Oopsie, that's not what I wanted. Well, that was higher. And now our new red line down here is lower. I don't know why I changed the color. But there we go. So, right, so the curve can go all the way up or down. And again, that's VIX going up, VIX going down. But also, and I don't like this line anymore, I want to change the color back. Put a green line back. So let's be. So those are what I would call those are two broad shifts. Now, what could also happen is the curves can flex from the at the money. So what you have is you could have, okay, all of a sudden your call skews can go up. So you're starting to get a kink on the upside. So this is exaggerated. Or your put skew can get super steep. So all of a sudden, generally when you have these sharp rallies, put skew increases. We'll go over the reasons why in another video, but basically, your at the money volatilities are kind of staying the same, but your downside vols are kinking up. But this is all higher volatility here, all higher volatility here. And also on, again, another coin here, your vols can kink down. So they can kind of kill the skew. Basically, demand for puts, whatever makes them go down. Again, this is exaggerated, but you've got your skew going down in this way. And then also your call skew, they can smash the vol on the upside. Now, this could be any term any term for SPX volatility. But if we're looking at VIX, that's the 30-day cohort kind of options. And so you have these curves. I know this looks goofy, but you have like volatility can move all kinds of different ways. These skew curves can move all kinds of different ways. So in order for VIX to go down when SPX is rallying, right? If you just get a kink up in option prices on the upside, that would be enough to keep VIX at least probably even. And the reason why is if you look at how VIX is built, let's say there. So because if I'm, let me pull up my other chart here and I can draw on it a little bit. Not that one. There she blows, right? So I think I can do a little drawing, maybe. Draw. Nope. I'll just move my cursor around here. So you notice how the volatility is on the upside. So this is August 9. This is a shot on July 9th. All these vols here are lower on the upside. And you have all these volatilities here. Implied vols per strike are higher on the downside. So again, it's roughly that curve I drew. So as SPX moves up, because of the way the VIX calculation is designed, remember this is back of the envelope, not exact back of the envelope, but for the most part, there's a square in the calculation of VIX. And it's roughly like a Vega weighted index. So you've got higher Vegas at the money. And if the volatility, if we keep moving, SPX keeps moving up. So when they recalculate VIX, all of a sudden you're going to have lower vol averages basically because all the vols on the upside, all your upside call vols are cheaper than your downside put vols. So SPX or VIX is designed to basically decrease as SPX goes up. That's just VIX reading whatever the volatilities are. And then as the market goes down, because now all of a sudden the Vegas are increasing per strike in the rough average, your VIX is going to go up. So if you kink the curve, the puts kink up, VIX will go up. If you kink the call skew up, VIX is going to go up. So it just has to be enough to offset whatever the average is mathematically. And then that's how VIX can go up when SPX goes up. So a real world example of that is what we just had recently where, so this is the VIX calculation. This is the August 9, 5600 call. So a few days ago, notice it's here. This is right before the holiday. This is the implied volatility curve, this red curve here. And you kind of got to a little bottom here, even though we have some value to the options still at 30 bucks. And then up. Right? So from 30 bucks to 70 bucks in 5 days. And notice implied volatility actually increased. This was an out of the money call the entire time. So volatility stayed firm and increased on the way up. And that's what's keeping VIX up over the last 5 days, basically. The fact that we're lifting and the volatilities aren't coming down on the upside. And that's how VIX can stay up. So part of this is where is demand for options coming from, how liquidity providers are pricing the 30-day, the chunk of options there. But that VIX is just, doing its job. It's just reading what the implied volatilities are. And that's how SPX can rise and VIX can rise. So if SPX is rising too fast, and if you think about it, we're only pricing the straddle at 130 bucks. If you're moving $130 a week, but straight up, $25 a day, like up, and then another week, up. In 2 weeks, you're up 260 bucks, 240 bucks. You've already blown the straddle out of the water for 30 days. So the liquidity provider essentially is going to drag that volatility at the money and sort of follow it up as SPX increases. And what that looks like is just your vols are increasing every day on the fixed strike. And that's how vol goes up. And the opposite can happen when, let's say, SPX is starting to go down, but it's not going down fast enough. What happens is the skew curve flattens slightly on the downside, the put skew flattens, and then the vols collapse from where they were relative to what they have been. And all those vols coming down mean SPX can actually drop. And VIX can go down when SPX goes down, just because the volatilities that the calculation is picking up, all those vols are collapsing on the downside. So understanding the skew can move in, right? The curve can move in many variations. This spaghetti map doesn't really help, but it gives you an idea of kind of broad changes in VIX versus kind of the little micro skew slope changes in SPX. And that gives you an idea of how the market, for volatility works in broad strokes and how VIX works. So it's not that VIX is broken. It's just VIX is reading what the implied vols per strike are doing. And what you can see is, since they're all different, you're going to get those different activities and get a different VIX calculation. And that is why SPX can go up and VIX can go up at the same time. And there it is. Have a good day. Andrew from optionbit.com. Check out weekly profit cycles if you want to learn to trade VIX and SPY at the same time and add an anti-correlated to SPX trading strategy to your portfolio. Have a good day. Bye-bye.